The reason I wanted to give you the background and the history of how markets work is so you understand really kind of what you're dealing with, but I want to go through some of the issues that we're seeing right now with the financial markets as it relates to these long-term issues. I pointed out earlier that we've got profit margins on the decline. Again, only time you have declining profit margins in the stock market has been prior to the onset of an economic recession. Again, very simply, you cannot have accelerating profit growth, which, by the way, is currently being predicted by the markets through the rest of this year, that we're going to have a big rebound in our profitability and growth rates of companies, without having a subsequent pickup in economic activity. Price to sales. Over the course of the last 6 years in particular, because of the changes to accounting that we did following the financial crisis, we changed the rules so that banks could mark assets to what they call myth. They could just book it at whatever they want instead of having to report it at market value. This allowed the banks to heal their balance sheets up very quickly, to reduce the amount of capital they needed, and also kept them from being broken up by the Federal Reserve. But that also led to a whole lot of other stuff that was happening on balance sheets of companies. Back in the day, there used to be a time when companies reported earnings, and they reported GAAP earnings, generally accepted accounting principles. They reported GAAP earnings. In other words, what went in this pocket versus what I spent out of this pocket led to my profit or loss. It was pretty clean and simple. In the back of the 10K, 10Q, whatever you're reading, they would have some footnotes that says, well, we had this one-time expense that we didn't expect to have, but if we didn't have that, our pro forma, or our projected earnings would have been Y. It's no longer the case anymore. Every quarter, when you hear a company report earnings, they report pro forma or operating earnings, which operating earnings basically strip out or include, depending on what's better for the company, these one-time adjustments, these one-time write-offs, to help elevate what is the actual earnings at the bottom line. Here's my point about this. Since 2009, earnings per share, what's reported at the bottom line, has increased by over 230%. So once I buy back stock to reduce the amount of shares outstanding, and I do all my fudging of my accounting numbers, which, by the way, companies have already admitted that about 20% of CFOs fudge their numbers to make better earnings reports. And I account for the wage suppression, the layoffs, all the cost cutting, everything else that fell to the bottom line. I've boosted earnings per share by 230%. So when companies announce earnings, say, hey, company beat the estimate. Isn't it great? But look at what happened at the top line. Revenue, or sales, is what happens at the top line. In other words, you go out to a store, you spend $1 at the store, they had $1 worth of revenue that day, right? You bought $1 worth of stuff. Sales, in total, since 2009 have increased by 27%. Not 20% annually, 27% in total. In other words, sales has grown at a very weak rate relative to what is being reported by corporations as profits. The 27% growth in sales, by the way, corresponds with what? A 2% economic growth rate. If you had sales that were growing at 100% or 150% since 2009, you'd have what? Stronger economic growth, because it's a function of what happens in the economy. This is why price to sales, when you look at what happens at the top line, price to sales is at the second highest level in history. In other words, outside of price to earnings, which reports all the adjusted operating pro forma fudge numbers, which is at 24 times earnings, even with that, you're now looking at the second highest level ever because of what's actually happening at the top line of companies, which is price to sales. But don't believe me. I put together an index that I run every now and then. I call it the Economic Output Index. what we want to know is what's happening in the economy overall. So I built a composite index. It combines several things. The Chicago Fed National Activity Index, which is an index comprised of 85 subcomponents. It covers everything across the economy. It's a big, broad index. But we're not going to stop there. We're going to add in all of the Federal Reserve regional manufacturing surveys. Philadelphia Fed, Dallas Fed, Empire Manufacturing Index, all that. So we're going to add all those guys in there. And we're going to add in the leading economic indicator index that I showed you earlier. So that's in there. We're also going to include the Chicago Purchasing Managers Index, the ISM Manufacturing Index, the ISM Services Index, and the NFIB Small Business Survey. All of it's included in one index. Covers everything. Manufacturing, covers services, covers, you name it, it's included. This is GDP, annualized. This is leading economic indicators. See a similarity here? This is the index. The little gold dots on the right are when QE started and ended. I wanted to point this out because when, we said earlier, when the Federal Reserve intervenes into the financial markets, it's to pull forward future consumption. So as you notice, when the index was declining, the Federal Reserve would step in and say, hey, let's inject some liquidity. You get an economic rebound because of why? You're pulling forward future activity. The gold dot at the top, that was when it ended. What happened to the economic rebound after it ended? It fell again. So the Federal Reserve steps back in, starts their next process, reboots economic activity. We are currently, two things to note here. First of all, that index has never recovered back to a level that is normally associated with economic expansions. It has currently been operating in recessionary territory since 2009. Now, I'm not saying that the economy was in recession since 2009. It's just saying that economic activity is more akin, in other words, the psychology and the activity of the market is more akin to what happens during a recession than what happens during an expansion. In other words, business owners are extremely close with their money. They're not reaching out and expanding a lot. They're not going to build new products and plants. They're not hiring a bunch of people in anticipation of more growth. They're simply hiring enough people to keep up with the rate of population growth. But that decline is telling you that economic growth is much weaker than what headlines currently suggest, even currently at 2%. This is margin debt. Margin debt is where people borrow money against their stocks to go buy more stocks. It's called leverage. Historically, so does anybody here trade on margin or understand margin to any great degree? Okay, let me just a real quick little sidestep here on what margin debt is. I just told you that margin debt is when I borrow money against a stock to go buy more stock. There's a limit to what I can borrow. If I have $100,000 in my account, that's all, and I own ExxonMobil. I have $100,000 worth of ExxonMobil. I can borrow $50,000 against my $100,000 of ExxonMobil and go buy more ExxonMobil, right? So I got about a 50% margin, give or take. There's some different margin levels depending on assets. Okay, the problem is this. When the stock price declines, my collateral declines in value. So if ExxonMobil falls from $100,000 to $90,000, how much can I borrow now, assuming a 50% margin? $45,000. But wait, I'm in debt $50,000. So I've got to go sell enough to clean up my margin. But the problem is that if I go sell $10,000 worth of margin to clean up my $5,000 shortfall, I then reduce the amount of collateral in my account, which then forces me to sell more to meet the next margin call. And if prices fall even more, it compounds very rapidly. And as I've said before, margin debt is like gasoline. There's been Barry Ritholtz and a few others, they've talked about the fact that, oh, margin debt's not a problem because margin debt's rising when stocks are rising, and it's absolutely normal. They're absolutely correct. Margin debt's like gasoline. If I poured gasoline all over the stage, I have no problem. as long as nobody lights a match. And that's the problem ultimately with margin debt. Margin debt's just fine. As long as asset prices are rising, people borrow money to buy more stocks. It creates more buying in the market. Market prices go up. Everybody's happy. The problem is when it reverses. And as you notice, when you've had peaks in margin debt, that has been correlated with bigger problems in the financial system. You know, the reason that Lehman was such a problem, I remember Lehman very clearly. I was in an apartment. I'd sold my house and had moved my family into an apartment. We were trying to close on the house. Had moved my family into an apartment so we could go buy another house. So it's me, my wife, 4 kids in a 2-bedroom apartment. She's not loving me at this point. That was September the 18th. If that date doesn't ring a bell, that was when Hurricane Ike hit. So I'm in an apartment in the middle of Hurricane Ike. Went to bed that night. Saturday morning, I wake up to the headline, Lehman Brothers in bankruptcy. Monday morning, Washington Mutual fails. The buyer of my house, his loan was through Washington Mutual. Now, fortunately, it worked out. I got the house sold. Everything was fine. But that's the reason I remember Lehman Brothers so vividly. But here's the interesting story about Lehman Brothers. Lehman Brothers itself was not a major problem. It was a credit issue. It was a counterparty issue. That wasn't the big deal. Companies go bankrupt all the time. But what happened at that particular moment when we froze the credit system was that you triggered margin debt. And if you go back and look at a chart of the financial markets in 2008, yes, the markets were coming down. April, May, June, July, the markets were tripling down. And they were declining. And yes, we were in a bear market already. But notice what happened when Lehman Brothers filed for bankruptcy. It plunged straight down. If you weren't out of the market before Lehman Brothers hit, you had no chance. We were down 700, 1,000 points a day, several days straight. And it was not because of just the credit system. It was because of the unwinding of the leverage. Because as the market collapsed, everybody was getting margin calls as fast as they could get them. There was simply no way to play catch up with a cascade created by somebody dropping a match on the gasoline. That's the risk we are currently facing here. We have more, that gray bar, that's what we call negative credit balances. That's the amount of balance that's outstanding short of cash in the markets. So in other words, that's the ability to cover liquidity if there's a margin crisis. In other words, there isn't any. This is GDP with some relevant data points about past crises. This is margin debt as a percentage of GDP. Now, I'm not trying to scare y'all to go run out and sell everything you own. This isn't the point. This is very slow to mature. My only reason I'm showing you this is that these are concern issues. These are things just to be aware of. If you're driving down the road and you see a lot of flashing yellow signs on the side of the road, do you speed up? That's all this is. These are just warning signs. I'm not trying to scare you. I'm not trying to say you should all be in cash. I'm not trying to send you running for the hills. But if you just want the rosy picture about the economy, go watch CNBC. They'll give you that all day long. And there's nothing wrong with that. I like optimism. I'm actually an optimistic guy most of the time, just not right now. Because I have money at stake. I have my family at stake. So these are very important issues for me. This is equity ownership. And now, this is different equity ownership than what I was showing you earlier. So earlier I was showing you business equity ownership. This is the amount of equities that households own. In other words, when a household is invested in the market, how much are they invested in the market? Relative to, say, bonds or cash. Right now, households, and you've heard this statistic, this is the most hated most hated bull market ever. Households just never got back in the market. Yeah, they did. In fact, they've got the second highest level of equity holdings since 1999. Now, That's by itself is not something to panic over, but the point is that if people are fully leveraged back into equities, in order to keep a continuation of a bull market going, where's the extra buying power going to come from? They're fully leveraged to the hilt because of where margin debt is. They are fully allocated to equities because of equity ownerships. Where is the additional buying power going to come from to continue to boost the market? And as you note here, ironically, the market kind of ebbs and flows with the amount of equity ownership. Not surprising. This chart is a little bit different. What this shows you, the line on top, the blue line, is the number of people investing in momentum-based stocks. They're buying, Facebook, Google, Amazon, anything is running on just momentum. The bottom line is people buying value stocks. That deviation has never been wider ever in history, period. None, zero, ever. By itself, that's not any major warning sign other than that will eventually reverse. And the problem with momentum versus value is that when momentum breaks, that is when you have the escalation out of the market. Because when momentum stocks break, like biotechs, they don't just gradually decline, they plunge. And when they plunge, that's when people panic and bail out. If you have a lot of people invested in momentum-based strategies, as that would suggest, a plunge in momentum-based strategies will also trigger the margin calls. That's why it's a warning sign. This chart is about earnings again. I keep coming back to earnings because it's the most critical thing in the markets. Earnings are the lifeblood. If you don't have earnings, you don't have anything. What the red line shows you is the level of earnings prior to their past peak. In other words, at what point were earnings actually growing at a level that was higher than where they peaked previously? Everybody follow that? That's why there's a straight line there across bear markets. When earnings fail to grow faster than where they were at their prior peak, financial markets tend to have a growth problem. And as you've noticed, and the three vertical lines show you exactly where earnings have quit growing faster than their prior peak, those have mostly been associated with the peaks of financial markets in history. Junk bonds also are a big warning sign. People buy, by the way, high yield is a marketing term that you need to throw out of your dictionary. High yield is a nice way of saying you just bought junk. Junk is companies that tend to go bankrupt. That's why they're called junk. But see, junk didn't market very well for Wall Street. When they wanted to sell you a junk bond fund, I'd say, hey, you want to buy this junk bond fund? No, not really. I'll go buy the good bond fund. High yield sounds much better. Want to buy my high yield fund? Pay 6%? Absolutely, I'm in. Load me up, baby. That's your high yield. When high yield begins to fall, that's also coincided with falls in the stock market. Why? Because that's where bankruptcy started to show up. Why are bankruptcies starting to show up? Because companies are going out of business. Well, why are companies going out of business? Well, because the economy is growing too slow and they're not making any money. Oh, I probably shouldn't be paying 24 times earnings for the stock I'm in. Okay. What this shows you is the topping process in markets. It's a little bit convoluted and don't get lost in the chart itself. But what this shows you is that every time the red lines, the vertical red lines, whenever all these indicators of momentum and relative strength and price movement have all coincided to basically tell you that market liquidity was leaving the markets, it denoted a peak, a major peak in the financial markets. The black lines show you when that was reversing. The point here is simply this, is that you have all of the indicators from momentum to relative strength to price action, etc., all telling you that we may, I'm saying may, I'm not saying definitely, so don't walk out here and go, he said we're in a bear market. No. We have all the indications that suggest that the acceleration in the financial markets from 2008 till now has likely come to an end. By the way, just from a standpoint, look at the ramp up in the market since 2009 versus the one in 2002, and you can go back to 1995 and look at the one from 95 to 2000. Does that even look normal to you? This is the same look. Again, I'm going to send you this presentation so you can actually look at these charts a lot closer, but here's the point. The S&P 500 is at the top, and it shows you basically the prior market peaks as compared to what's happening with prices today. Every one of the bottom indicators are some measure of momentum, relative strength, price direction, etc., and they are all in a decline just as they are all in decline now, just as they were at 2008 and in 2000. Coincidence? Maybe. But it's just something to pay attention. The very bottom, by the way, I want to note something for you, and because we're going to talk about the rally this past couple of weeks. The very bottom one is the number of stocks trading above their 200-day moving average. The S&P 500 broke above its 200-day moving average earlier last week. The index as a whole, 500 stocks, are above the 200-day moving average. However, the number of stocks within the index is not only still in decline, it is only at about 57%. In other words, just barely more than half the stocks of the S&P 500 are above their 200-day moving average, even though the index itself is. That's called breadth. And when you have narrow breadth, you have a weak market. So it's more dangerous. You just want to pay attention to this. So what people tell you is like, oh, this is great, market's going up, everything's doing awesome. Not so much.